Here's a question that keeps investors up at night. You've got $10,000 to invest. Do you put it all in the market today or spread it out over time? This decision could literally cost you thousands of dollars in returns. Today, we're settling the debate between dollar-cost averaging and lump sum investing once and for all, using real market data that might surprise you. Let's start with the uncomfortable truth. Most investors get this decision completely wrong. They overthink it, they procrastinate, and they end up losing money simply by waiting for the perfect moment. But here's what the data actually shows. Dollar-cost averaging means investing a fixed amount regularly, regardless of market conditions. Think of it like this. Instead of investing that $10,000 all at once, you invest $1,000 every month for 10 months. The idea is simple. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this should average out your cost per share. Lump sum investing is the opposite approach. You take that entire $10,000 and invest it immediately. No waiting, no timing, just get your money working in the market as soon as possible. So which strategy actually wins? Vanguard analyzed market data going back to 1926, and the results were clear. Lump sum investing beat dollar-cost averaging roughly 68% of the time. That's more than 2/3 of all time periods studied. Here's a real example. In 2009, during the financial crisis, if you had $12,000 to invest, the lump sum approach would have resulted in a portfolio worth about $89,000 by 2023. The dollar-cost averaging approach, spreading that same amount over 12 months, would be worth about $84,000. That's a $5,000 difference. But wait, there's more to this story. The reason lump sum wins most of the time is simple mathematics. Markets generally go up over time. The longer your money stays out of the market, the more potential growth you're missing. Every day you wait is a day your money isn't compounding. However, dollar-cost averaging does have one major advantage. It reduces your emotional stress and helps you sleep better at night. If you invested that lump sum right before the 2008 crash, you'd have lost 37% of your money in the first year. That's psychologically brutal, even if you eventually recover. With dollar-cost averaging, your maximum loss would have been much smaller because you weren't fully invested when the market crashed. You'd still lose money, but the pain would be spread out and less severe. Here's when you should use each strategy. Use lump sum investing when you have cash sitting around doing nothing. You can emotionally handle market volatility, and you're investing for the long term, at least 10 years. The math is on your side. Use dollar-cost averaging when you're just starting to invest and building the habit, when you receive money gradually like from your paycheck, or when you honestly can't sleep at night knowing all your money is in a volatile market. There's also a hybrid approach that many smart investors use. Invest the lump sum immediately, but in a more conservative portfolio, maybe 60% stocks instead of 80%. Then, dollar-cost average into your target allocation over 6 to 12 months. This gives you the best of both worlds. You're in the market immediately, but you're reducing your risk exposure. Here's something most people don't consider. The size of your investment matters. If you're investing $1,000, the difference between these strategies might be $50, $100 over a year, not life-changing. But if you're investing $100,000, that difference could be $5,000, $10,000 or more. Let me share a powerful example from the Japanese market. If you had started dollar-cost averaging into Japanese stocks in 1989, right before their massive bubble burst, you would have actually done better than lump sum investing for the next 20 years. This shows that while lump sum usually wins, there are periods where dollar-cost averaging provides better protection. The biggest mistake investors make is analysis paralysis. They spend months researching the perfect strategy while their money sits in a savings account, earning 0.5%. Remember, time in the market beats timing the market almost every single time. If you're still unsure, here's my recommendation. Start with dollar-cost averaging to build the investing habit, but as you get more comfortable and your account grows larger, lean more toward lump sum investing for any windfall money you receive. The most important thing is to start investing, period. Whether you choose dollar cost averaging or lump sum, both strategies will put you miles ahead of the person who never starts investing at all. The perfect strategy that you never implement is worthless compared to the good strategy that you actually follow through on. What strategy are you going to choose for your next investment? Drop a comment below and let me know. And if this video helped clarify this important decision for you, hit that like button and subscribe for more evidence-based investing content that cuts through the noise.